We love rock stars. Rock stars are easy and they're fun. And so, after we had some discussion, they decided that, like many grandparents, they would like to financially assist their daughter. And the idea was, can we start a Roth IRA?
Their granddaughter, you mean?
Their granddaughter, thank you. And the answer is, of course. But how do you do it? This child is 12 years old, which for many cases we don't think is really as a child anymore. They're growing. But you have to have some level of earned income. So my question to them was, is she sweeping the floors? Is she cleaning out the barn? What is she doing for you? Is she doing that, and are you paying her? And the answer was, yeah, we're making her do this stuff because it's character building. It's fun to do together, but we're not paying her. So it's like, well,
now you can.
Now you should.
The smart way.
That's right. So the smart way is, let's then take some of that money and move it into a Roth IRA. That's one option for her, so that we can have this money grow income tax deferred. I mean, realistically, she could even do a traditional IRA, but Roth sounds like it's more fun.
Well, there's probably going to be a limited amount of time that she'll be able to contribute to a Roth because there are income limitations there. And, she's in a no tax bracket right now, and she has no income. So there's there's not necessarily an advantage like there is for most working adults where you want to take the deduction because it lowers your tax liability.
And certainly we know that there are some limitations. I mean, especially because she can put in up to $6,000
or 100% of her income, or $6,000.
Thank you, appreciate that. And certainly, these tools were not available, honey, even when you were younger.
So, what did they become popular in 1991? I think.
Yes, exactly. That's when that was actually the beginning of Roth and the true opening up of 401ks, etc. So, we talked a little bit about that. And obviously, there were tax consequences that were involved, which is fine. But I think Rob, in his own creative way, also had another idea in mind, one that he floated by these folks.
I did. What if we took $3,500 of that farm income that you weren't doing anything with,
and including not giving her as a Roth contribution?
Correct.
Because we've got $30,000, just to remind the listeners, of excess income.
Right.
What if we were to direct that towards a life insurance with Emily as the owner and her granddaughter as the beneficiary?
Okay. So we're going to have Emily as the owner on the policy on her life, and her grandchild being the beneficiary.
Yes. And the cash values inside the contract would grow income tax deferred, would be one benefit. Another one would be the cash values could be accessible by loan if needed. But the best benefit, in my mind, with the benefits would be received ultimately income tax free.
When Grandma passed away.
Correct.
Yeah, so the money would become available at exactly the moment that it was needed. And we've had many discussions here on the air, but also certainly in coaching systems with clients. And they all seem to pretty much be in agreement that had they been in a position where they had received a lump sum of money, income tax free, sometime during their 20s and 30s from grandma or grandpa, their life could have been changed and maybe very much towards the better.
Sure.
And I like that idea. I mean, I just imagine, most folks in their 20s and 30s, I'd like to say, they're broke. I mean, they are. They have more obligations on money than they do have cash or even cash flow. And some of these kids, who knows, they could be maybe entrepreneurial. Wouldn't it have been neat to actually have investment capital available to them that they received income tax free?
Or they could have bought a home earlier.
Yeah, I mean, but think of the alternative, And it's funny because this came to me, as I've told clients, I mean, this came to me in the shower a couple of years ago. That's where I do most of my thinking, is in the shower. And I'm not a throne person. So I'm thinking to myself, I'm going to be here a long time. Probably I'm 65. I'm going to be here most likely. Normal mortality. I'm going to be here for another 20 years. God willing, another generation is going to be created, and etc. And at that point, they're by the time I leave, they may be in their teens, maybe getting ready to be 20 years old if I'm lucky. Forget great grandchildren. Never see that. Well, I mean, it's true. I mean, it's statistically. I mean, unless it's me and Moses, I'm never going to see these kids. But why would I want to wait or have my grandchildren wait until they're my age before they inherit money from their parents? I mean, that's really what the traditional thinking is, right? What happens is that, everything is passed from parent to child, and then children take care of their children. Well, with mortality, if I do it that way, instead of doing something, Rob, which I thought was great that you brought this out, and I know that people were really interested in considering pursuing this, delivering money at a time to them, which was independent of their children's decisions.
Absolutely.
And at the same time, getting into their hands at a great time. I mean, at a time they needed in their life.
We've short-circuited that process you just said by skipping a generation and going from grandparent to grandchild, which, like you said, it gets the money to them at the exact point where they have so many different pulls on that income.
Yeah, and I think at the end of the day, we're really looking at, okay, how much could this money grow?
Between now and then.
That's right, between now and then whose hands is it going to be in?
I also think for the grandparents out there that are thinking this might be a clever idea,
it is.
You can work the equation multiple ways. One would be, I know that there are a lot of grandparents out there that gift money to their children, to their grandchildren every year. Maybe instead of gifting them an actual dollar amount, you put that gift towards a life insurance premium. So you can say, well, what does my annual gift buy in terms of a death benefit? Or right. You could say, I want them to have a certain amount of money when I pass away, and you can work the equation backwards, which is, do you want to pick the death benefit first, or do you want to say, like, for example, Emily and Bill have $30,000 of excess income, or they only have one grandchild now, but if they had more than one, maybe they would say, we have $30,000, we have 3 grandchildren, we're willing to do $10,000 a year, whatever that buys.
Sure, and Rob has become an expert in these numbers, and we've been talking about these for some time. And I think it's kind of cool because we know that basically $3,500 for a 70-year-old person, female,
non-smoker, standard
risk, buys about $100,000.
That is correct.
Which is cool, and that's a continuous pay contract as compared to if you go, okay, what if we only want to pay for 10 years? We basically double that amount. And it goes to 70,000, etc.
Which also means you could be doing multiple grandchildren. You could be laddering them practically.
Exactly.
Really blow up the estate.
Yeah.
Well, I mean, what's happened is that these contracts have literally become an algebra problem. How long do you want to pay, and how much do we have to input? Right. And we can go back to the computer and say, okay, based on today's interest rates, boom, this is what it looks like. Fitting your lifestyle, your needs. I guess, at least, and honey, with me, this whole intergenerational wealth transfer it's just blown up. It's just become so big because the change in the IRA laws really force us to consider, assuming you want to keep your eyes open, force us to consider that which couldn't happen before.
And also, we really have to go back to the fact that the baby boomer generation really is the first generation that has the opportunity to do this.
Has real capital.
Real capital because, you're the first generation that really experienced shifting from defined benefits to defined contributions, meaning losing pension from your employer and gaining access to 401ks where you had to save for yourself. So, and, also experiencing 20 years of a fantastic market over time. So you're really the first generation that has the ability to start some of this intergenerational wealth planning. And it's not just the rich guys, it's the people down the street that spent their entire careers working at large corporations or even small ones in St. Louis and Illinois. You have the chance to...
Well, not only that, but also we talk about the regular folks, which is
Right.
somebody's a plumber, somebody's a machinist, whatever it would be. I mean, they've been putting money aside. Their union has been putting money aside forever. And
They've got both pension,
right, and
retirement plan.
what they call the annuity, and
Right.
so what happens is these folks have a lot of money at the time, much more than our parents did or considered having, and you don't have to keep your eyes closed. I mean, if you open your eyes, you can truly do some planning and put yourself in a position where, as I like to say, put your thumb on the future on the future generations.
Sure.
I mean, this country, I don't know, cynical or whatever. This country's all about money.
Well, it just gives you opportunity. It gives you freedom.
Options.
Right.
Yeah, the more that you have, the better off that you are. And I guess I always like to think, hey, wouldn't it be cool if somebody in their 20s and 30s had capital,
Mm-hmm.
had the opportunity? Are they going to take it to the casino? The truth is they don't. We have beneficiaries that we're talking to. It seems like at least monthly. When someone gets most children grandchildren, whoever it would be, they receive large sums of money. They're smart. They realize that this was a gift, truly, and how can I take that gift and make it grow over long periods of time and make it more valuable? And really, if you think about the Generation X, whatever the generation's called now, they're going to change the letter next week. If you want to get out early, you want to get out of the working world earlier, the only way you do it is by having capital. So putting that capital to work for you, enabling your life, it's great. It's just great. And it's just something that I know my grandparents would love to have helped me with, but they didn't have any money.
Well, the other thing is that what I've noticed is the apple doesn't usually fall very far from the tree.
Yes.
So if you've done an excellent job of saving and living within your means, and you are able to retire, and you have this excess capital available to you to be able to do these things, most likely you passed a lot of those traits along to your children, which is saving, being conservative with your money, living within your means.
Delayed gratification.
Right, planning for the future. So I would say that most of our clients are relatively confident in saying that that's even been passed on to the next generation. Even if they're young and they don't exactly know what they're going to do with their lives, they have these values instilled in them.
No, I mean, I think at the end of the day, it's very fair to say vanilla isn't the only flavor anymore. There are lots of flavors, and truthfully, you can create your own, whatever your family dynamic is. The neat part is that working with someone that can help you and assist you in getting there, I feel like is probably the most valuable job that we're going to do for our clients. I mean, we love making their money grow. I mean, that's what they pay us for, preserving, protecting, and prudently grow. But also passing it on to the people that we love in the most effective way, in the way that they want it to be done. It's nothing better than that. And watching that happen, I know, honey, you've had an opportunity to do this. Watching that happen is truly gratifying because you know that you're really that they were able to create an impact on their children, their grandchildren, and pass on family, if you can, financial security, which there's nothing better than that.
The really cool thing that I've been able to experience now is, people that are getting ready to retire, this isn't top of mind for them yet because they're still focused on, do I have enough to retire? Is the math really going to work the way that I think it is? Are all these pieces going to fall into place? But now that I've been with you for 10 years, the people that have been retired from the day that I joined you, Dad, people were retiring with you and you were designing game plans for them. Now they've been using those game plans for the last 10 years, or maybe it doesn't quite take 10 years to get there, but now those people are looking and saying, well, I see the path for myself. I've been comfortable and happy on my journey. Now what do I do? Now how do I help the next generation? I'm ready to do that now. So it's pretty cool to be able to see that.
Yeah, and what's also nice is that even though right now we're in a market downturn, and we have been for about 10 months, 11 months,
An
that
eternity.
hasn't. Yes, it feels like it. That hasn't derailed their plans.
Certainly not.
If nothing else, what it's done is given them an opportunity to say, "Hey, can we get there? Do we need to change our focus? Are we in the right place?" And this is fun. I mean, this truly is a lot more fun than it's been really in the last really for the last 30 years, because the IRS basically has given us a cue to say, "Okay, start planning." And when the government gives you the cue, you got to take it. I mean,
Right.
you don't swim upstream. Everyone's documents that have been done in the past, they don't necessarily have to be redone, but the game plan has to be modified to basically deal with the tax law, which doesn't really, in most cases, require their documents to be redone, but the focus has to change.
Sure.
So that's kind of a cool thing. So I really did enjoy not only that session with Bill and Emery, but also with Rob, because
This is a hypothetical situation based on real-life examples. Names and circumstances have been changed. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments or strategies may be appropriate for you, consult your advisor prior to investing.